All right, well, we'll get started. I am both hosting and presenting today, but Andy's helping admit people. Today, we are going over the final investment decision. So just a reminder, there's kind of 3 phases in the deal search. And this is somewhat unique to Acquira, but we have the pre-LOI, right? So obviously the deal search. Then we have the diligence phase, which we call the LOI to the FID. And the FID here is the final investment decision. And basically, that's phase 2. And then the final phase is the FID to close. So the reason we introduced the FID was because, firstly, we wanted to ensure that there was an objective way for people to analyze the deal. Because after you spent often many months or even years in that first phase, and you know it's hard to find a deal, and then you spend several months looking at a deal, you can become very emotionally attached. And I really want to make sure that people can logically look at deals and, post diligence be able to say that this business is less valuable than I thought it was, or even this business is more valuable than I thought it was. So that's the principal reason. There's also a financial commitment that you'll be taking on, which is primarily legal. So you don't want to take that on if the business, is unlikely to close. And then it's also an important moment for you to start considering taking on some lifestyle changes or committing to some lifestyle changes in the next 60 or so days post FID. So things like relocation, quitting your job, all of that stuff sort of makes sense because after the FID is done, and we'll go over a few things you need to do, it's very likely that the deal closes, right? I'd say it's probably about a 20% or less chance that the deal falls through at that point. So that's why it matters. For people who are maybe pre-LOI right now, and they're not at this phase, I still think this is an important call, even if you're not there. It'll help you understand training going forward, and I think it'll also help you start looking at deals pre-LOI. And then, you'll hopefully remember this call and return to the recording when we get here. Okay, so some key training to consider is the intrinsic value second pass. So if you go to Thinkific, it's actually called, so there's actually 2 pieces. One is called the last mile from the signed LOI to your final investment decision. And then the other key piece of training here is the last mile using the intrinsic value calculator in-depth pass to understand your deal. Those are, if you look at the images, those are in the 201 category. What it does is it kind of points to that intrinsic value calculator, and we'll go through a bunch of that. And we're also just spec'd it out a week ago, but we're going to update the training, and we're going to include basically an FID deck, kind of similar to how you guys have and do the investment committee right now. Is we're going to actually include a deck that includes everything you need to look at. So I'm going to actually just share an outline of that deck right now. This is not the final version, but I can walk through a lot of the things we need to be considering while at that FID point. Most of the time, this FID happens within about, I'd say, 60 to 90 days of signing an LOI. And so typically that means you've done the QOE, you've gotten a QOE done, and then you've also gotten through most of or all the key items in that post-LOI diligence list. Okay, so when you get your QOE, you want to make sure that your proof of cash lines up. That'll be a section in any QOE. I've mentioned this in the past, but it bears repeating. When you're talking to a vendor, it's good to ask them if they can basically split up your cost between proof of cash and the full QOE. Just because proof of cash, if it doesn't line up, you may decide, just not to continue with the QOE. By the way, if anything here is confusing, please just raise your hand in the chat. Andy, you can, or Dana, if you don't mind just interrupting me and letting me know with the question. So the proof of cash is basically, an accounting. process where you're effectively going through the bank statements and making sure that they line up. Go ahead, Dana.
Yep. Sorry, hit the wrong button. My apologies. Go ahead.
The next thing that you'll want to make sure is whether add-backs line up from your QE and whether they can be substantiated. And again, that should be part of the process of any QE vendor. So there are simple things that are obvious, right? So like, interest and amortization, that type of thing. Other items, salaries, stuff like that. That's pretty simple. But often sellers will put in personal expenses and call them add backs, and the QA may be able to, not substantiate that add back. That's possibly an opportunity for you to adjust the purchase price, the terms somewhat. It's up to you if you want to do that. I've seen all sorts of things from like people putting, construction companies putting, the renovations of their own house through the business. Makes sense. If you were the owner, you might do that as well. But often it can't be substantiated. And so it is a bit of a lever for you to pull on in regards to negotiation. This is also an opportunity to look at your year-to-date financials, because often, since the LOI, it could be that 2 or 3 months have gone by, or it could be that, 2 months have gone by, but, the financials that you were looking at pre-LOI were already 2 months old. So you have 4 new months of financials. If that's the case, this is also an opportunity for you to either adjust the purchase price or more often adjust terms. So as an example, today it is November. Let's say I got a LOI in back in, let's call it end of August. And when I got that LOI in, I really only had numbers up to May. Today I might be at that FID decision. I may now have, all the May, June, July, August, September, October P&Ls back, and I may see that the business is declining, on a path to substantially decline. This is a good time to adjust the purchase price, or at least introduce a forgivable note. So we just discussed this. Part of the QE will also talk about working capital calculations. Again, I've done other presentations on like the deal killers. Working capital is a deal killer. Part of the FID is getting on the phone with the seller and making sure that they understand working capital and what it means. And often you're going to use the actual QE to your advantage here. And so you need to be very frank to say, hey, just want to make sure that we agreed as per the LOI that the working capital, would be, left as it has been, and here's what it looks like. And you need to leave $450,000 in the bank. And sometimes the seller will not understand that, and you want to make sure that you're on the same page before you move forward. Post LOI diligence checklist review. So there's like 200 questions in that diligence checklist. You don't necessarily need to have every single one, but I'm going to be doing an update on it in the next, should be published in the next couple weeks, which will actually sort of highlight the things that I think are non-negotiables. Next is the intrinsic value second pass. So again, I highly recommend if everyone on this call review the content here and specifically review the second pass calculator, which is different from the first pass calculator. I can share a link to it. But basically, each of these items, and again, I'm going to be turning this into a presentation, each of these items should be identified as part of the FID, and you should be looking at risk mitigation on every single one of them. So size of the adjustable market, percent market share, in my books, fairly large market share, being a big fish in a small pond is a risk. How do you mitigate that? What happens with the gross profit trend if you actually identify during diligence a lowering of margins over time? How do you mitigate that? Again, you need to look at this in depth because there can be instances when, especially if a seller has been looking to sell and sort of positioning to sell their business, they could have made, OpEx declines over a period of years in order to show a growing business from an SDE perspective. But those OpEx declines can sometimes correspond with gross profit declines and still look like a growing SDE business. That's a situation you want to avoid. Seasonality, again, post-diligence, part of the QE, you'll have a whole few slides on seasonality, understanding if it actually exists in the business, how to mitigate it. Obviously, that's a bigger deal with roofing and HVAC businesses, less so with plumbing. Go ahead, Antonio.
Hello, Hayden. A couple of questions right now. QOE, you mean quality of earnings?
Yep.
Okay. And the other one is there a way to know if the working capital can come from the accounts payable or something, or is there a metric for that?
It can. After this, we'll Andy, if you could send Antonio the AP call we did on working capital a few weeks ago. There's a whole, we've gone over this quite a bit. It's
all right, thanks so much.
Yeah, we'll do that.
All right, thanks.
Customer concentration. There's a whole sort of outline on how we, at least how I approach valuation adjustments or potential terms adjustments based on customer concentration. In the QOE, part of customer concentration is also looking at referral concentration. So a lot of different businesses, GCs might have brokers that refer customers, even though their individual financial or economic customers are quite distinct. The same goes for, a countertop business could have, builders that one builder that refers 40% of their work, but the economic user is often that builder's customer. So you're going to need to identify that. Key man risk and the risk mitigation strategy, same idea. We look at this as if any individual were to leave, what would that represent in the following 12 months gross profit? Again, I always look at gross profit. I don't look at revenue because not all revenue is equal, and you'll learn about that in your QE as well. And then how long does it take to replace them? And so based on that, there's sort of different categories, and it adjusts the purchase price or again, potentially the terms accordingly. And then management depth. Typically, if you're buying a business at a 3x multiple, it's typically implied that there's not a ton of management depth or operations sophistication. So you may not need to mitigate so much as it could just be an opportunity that the business is more valuable than you thought. And what you'll often find is that you get a bunch of negatives here and then sort of a few positives towards the end. But the goal is to use this. Let me just load up an example. So here's an actual example of a business that I was looking at personally about several months ago. It was a construction business. I'm probably gonna update the training here, but I actually showed the business before FID, the business after FID. And for people that haven't used this sheet, I'll post it in the Google link. But this sheet has actually the scoring table for all the criteria here, and so you can just go through this, so you don't have to go back to Thinkific over and over again. But it's pretty much everything from about here onward is kind of unique to the second pass. And you'll notice that there are some things around, well, first of all, the EBITDA could change. In this case, we'll get to it, but though the EBITDA actually looked better by the time I did FID, when I looked into the WIP, the future EBITDA for the coming year was definitely going to be lower. And that's something we're going to get into when we talk about WIP. And overall, you can see, the business, the intrinsic value beforehand was 14.4 million. After the fact, it was 16.8. right? So this is a positive FID, and we decided to move forward, and we ended up, going forward and paying for legal. So we practice what we preach here. You should also have a filled out SBA calculator with the new numbers, and making sure that your DSCR still stays positive, that your down case still looks positive. For me, I personally model a down case at like a 10% hit to revenue year 1, and then no growth years 2 through 5 in that calculator, and make sure that my DSCR is still positive and that the business can still, obviously make its debt payments, and then some. Before FID, you're going to want to know your licensing solution. You're also going to need to communicate this specifically to banks. So, typically you want to have sort of plan A, plan B, plan C. Plan A is almost always going to be, can the seller provide their license for a period of time, minimum a year? Plan C is probably always going to be, can you get the license? And plan B is often who within the company has a license. And in certain markets, you can, rent a license legally. Work in progress is something you always need to look at as part of FID if you have any kind of construction or project-oriented business. Typically speaking, in any construction business, your backlog or your WIP determines usually the next 12 months or so of gross profit within your company. Your backlog, so just for making sure we have like a glossary here, work in progress in my mind is contracts that have been signed and have started, meaning that you've actually already begun work and build, right? Backlog is contracts that have been signed but have not yet started, so they're 0% complete. And the reason this is different is that WIP is very likely to continue. Backlog may not start for several months because for whatever reason, you may have permit issues, you may have financing issues. So backlog, I would say, is less assured, at least on a 12-month timeline. Often in this industry, people just call backlog the combination of WIP plus backlog, but I like to differentiate. And then finally, bids. And most companies don't do a good job of tracking their bids. So this is a massive opportunity. They don't do job costing, they don't do bid tracking. If you do bid tracking, you will understand how many bids you need to make to win backlog. And so that often will look, if I'm buying a business today, my WIP may cover, all of the gross profit that's going to come into the business, or the majority of the gross profit that'll come into the business until November of 2025. My backlog may contribute towards, let's say the tail half of that plus another 6 to 12 months. And then any new bids coming in are likely going to come into around, trailing 2025, maybe the last quarter, and then into 2026. Here, I'm not talking about, for the purpose of FID, we don't typically look at bid rates, but we look at the WIP and we look at the backlog. And typically for construction businesses, a pipeline of 10 months, pipeline for me is a combination of WIP and backlog. 10 months of gross profit is green, that's really good. 7 to 10 months is decent, and then under 7 months is red. So what that typically means is like almost definitely if you have under 7 months of pipeline, almost definitely, unless the business has really short cycles and smaller projects, the business is going to underperform next year. Site visit is also part of the FID. Go ahead, Nate.
Hey, sorry, just to kind of double tap on the negotiation piece for the pipeline. When you're talking with the seller, how do you typically go about like that kind of give and take of what they get in accounts receivable versus what you're, going to take, so that you're not, they don't get billed up front and then you have to hold the expenses to continue some work?
Yeah, so typically it's a complicated discussion. Typically, you'll end up having kind of two books post-close.
Yeah.
And a lot of it will come with also like how retainage works in the company.
Yeah.
But it'd also be part of your working capital discussions. So do you have a specific example?
Yeah, I mean, I guess I'm trying to think like best case scenario versus worst case scenario, right? I had one seller that it sounded like his gross profit was, it looked like he was dropping the price and juicing up revenue, right? And it was interesting, but my concern would be that he's going to take away some of the upfront billing that he gets, and then I'm going to be left to do the work post.
Yeah, the issue is like whether or not their WIP actually tracks like overbuild and underbuild, and then also whether or not it's accurate. If they don't track it at all, I would say like on any large contracts, that needs to be part of your diligence. That's typically past FID, right?
Yeah.
But especially if there are certain like very large projects, if there's a project that represents like 20% of the WIP, I'd probably do that beforehand. But unfortunately, if they don't have good practices on it, that it's difficult. It's difficult to do, right?
Mm-hmm.
Buyer, so it's a risk you take.
Okay. It depends. Got it.
Yeah. In a perfect world, so in the example business I was talking about,
yeah,
he actually did track his underbuild and overbuild.
Okay.
But what I kind of learned in that business and have seen since is like a lot of construction business at the end of the year adjust that. Because some of those amounts and the gross profit margins, basically it's a little bit of a nefarious practice, but it can adjust. It's getting into a lot of detail, but
Sure.
feel free to read that if you have specific questions.
Okay. No, that makes sense. I appreciate it.
Site visit. So typically, you will do multiple site visits. It's already assumed that you're going to do a site visit to check out the business, right? Check out the state of the assets, see what the overall energy and feel of the business is. But there's another site visit that you're going to want to have to meet key personnel. Sellers, I would say 70% of sellers are really, really nervous about allowing this to happen. Another 30% are really open. I would say that there is really positive correlation with sellers that are open to letting you meet personnel and having strong cultures. So that's one thing to say. I wouldn't say that it's negatively correlated to that if they're not open to it, that it's a bad culture. It just might, there may be good reasons for that. That being said, ideally, you would want to have a site visit at least to meet the key people that you've identified in sort of that intrinsic value that if they left, it would result in, a gross profit decline. If not, you need to at least have the agreement to meet with those people while you're at least going over the draft of the purchase agreement. My personal preference is that you have this done before then, so you don't get surprised by it later. And I would never buy a business from a seller who wouldn't let me talk to their people. Never, personally. I know other people have done it. CapEx requirements. This is something that's probably lacking from the training a little bit, so we're going to add it in. Actually, understanding what new investments you'll need to make into the business, especially in the first 2 years. So like, will you need to expand the office? Will you need to, work on buying a better water treatment solution? Will you need to buy vehicles? Will you need to buy new machinery? That will greatly impact some of the cash required in the business in those first 2 years. So keep in mind, this presentation is like a checklist of things you want to make sure you have before you basically give a thumbs up to the FID and get started on sort of the legal and banking paths. Next one is seller transition. So what have you determined? How long, we've gone over this quite a bit, but making sure, this might have already been in the LOI, but just making sure it still aligns, because 90 days could have passed, and we've had situations where a seller was, pending a move to another state at a given date, and diligence took longer than they thought. And so, the transition went from being several months to being, 2 weeks. So just making sure you kind of double click on this before moving forward. What's your equity plan? So are you going to do a HELOC? Whether or not you need that, there's other reasons people might want to, take equity out of any real estate they have. We'll use ROBS. Are you going to use external equity from Acquire Capital or any other source? Our family gifting equity. Consider seasoning requirements for all of the above. And then have you spoken to your banker about closing cost reimbursement, which is, we call it sort of allocation to equity injection. All those things should be checked off. And then, is it going to be a stock purchase, an asset purchase, or a stock purchase with a 338H10 allocation? This is a big deal. It's a big deal to the seller as well. Again, it might have been included in your LOI that it's going to be stock with 338H10. That's another one of those things that the seller might have just looked at and said, I don't know what that is, and not thought about. So it's something worth exploring before moving forward. From the generally speaking, the difference between an asset purchase and a stock purchase from a tax perspective for the seller can be, 20% of the purchase price the other way around. So it's important to double click on. And that's basically it. It's a lot, but this is your go or no go. And if it is a go, then that's where, like I said, you're going to be preparing the banking and the legal paths. In a future call, maybe next week or the week after, I'm going to share the fulfillment engine on those two paths as well. And then if it's a no, you basically try to renegotiate the deal. And if you can't, you withdraw. So that's the presentation. I assume there will be questions. So if anyone has any questions, please shoot. Go ahead, Nate.
So I'll ask one more on CapEx, and this is a pretty specific use case for manufacturing. So, a lot of the machines, the company will rate the machine for 10 years, right? That's the usable lifespan, but that's in practice, most of the older companies, you'll have a machine running for 15, 20 years if you've got an average maintenance plan. When you're trying to negotiate CapEx, right, what is the level that you put on, hey, your machine's 20 years old, I'm gonna need to buy a new machine, versus, realizing, okay, this is something that I probably will just need to get a new machine. It's my problem anyways. I guess I'm trying to figure out where do you push the seller versus where do you usually kind of let off? And I'm sure it depends as well, but.
Yeah, I would look at this from I would have a pro forma P&L for the business based on what you honestly expect CapEx to be.
Yeah.
And so if something is 20 years old and or based on the industry, the usable life is probably 15 years, and you think reasonably you're going to have to replace that, I would look at that, and if it's part of your pro forma P&L, yeah, you definitely can use it as a negotiation point, because if you compare apples to apples and you're comparing this business to another business that doesn't have that CapEx requirement, suddenly this business is less valuable.
Got it. So if they haven't been keeping up with maintenance, probably finding what's a good maintenance plan, what that typically costs for something comparable, and then saying, hey, that might need to go into working capital. Exactly.
And then, yeah, how well documented is maintenance, right? Are they massive machines that have, a vendor that actually comes in and have maintenance agreements, or is it, just the one guy in the office who knows how to maintain their machines and they say they maintain it?
Probably the latter.
Mm-hmm.
Okay, I appreciate it. That was my question.
Yep. Yeah, I got 25 minutes allocated here. So if you guys have questions on anything, I'm happy to answer as well.
If nobody's going to ask a question, I'm going to ask another question. Okay, so how do you kind of deal? What's the best way to negotiate? So post final investment decision, right? You've aligned with the seller. You guys are go. Everything's good. There's sometimes banks will drag their heels or take a long period and kind of come back, right? So it's kind of that last post, the last mile there, it belongs to the bank. I'm thinking specifically about a transaction that took like 8 months for the bank to get its stuff together. How do you manage that relationship, and two, like that drastically changes this, like how involved the seller has to be for longer than they had to be, right? So, do you get new taxes, right? What does that look like?
I would say align expectations pretty early.
Yeah.
So every seller and broker will be like, yeah, I want you to have a 30-day diligence period and the business needs to close within 70 days or something, right?
Yeah.
That's not realistic, right? Especially if you're using an SBA. I would say align and say, hey, the diligence period has got to be at least X days after receiving all diligence materials, understanding that receiving all diligence materials will likely take a month. And that the actual sort of closing period is going to be at least 3 months, but often, 5 months. And I would say that so after that phase, you are chasing a deadline, like basically a closing date deadline. And you're the person really who should be, I'd say, the leader, and pushing everyone towards that deadline, even though that deadline is probably going to be missed. If one thing to keep in mind, like especially this time of year, it's very rare that business actually close between Thanksgiving and the New Year. So just keeping that in mind, that could extend, closings by a month and a half. And just understand like the sunk cost fallacy here, right? Like I've never seen a sellers are pissed about it, but I've never seen a seller be like, all right, that's it. I'm leaving the deal because it's taken 5 months and you said it was going to take 4, right? Or 6 months and you said it was going to take 3. Because them going back to the drawing table, now they know it's going to take somebody else 9 months, right, to get where they are today.
Okay. Yeah. And I think your point on the pipeline, right? It's just also being transparent on them knowing what levers will impact your sell price, because that, even if it changes over a 6-month period, like they know what it's tied to.
And understanding that's usually a third party that's holding things back, right? Which can be your mutual enemy.
Fair.
Sometimes the third party is the IRS.
Yeah, I appreciate it.
Go ahead, Stephen.
Hey, Hayden. Just dealing with a scenario and wanted to get your opinion on it, but it's like one of those cases where it seems like the owner's running all of his personal expenses through the business, and so the SEE, they're claiming like $1 million, but their tax returns are showing like 200K. Pretty massive. So I guess how do you like determine, like, is it worth doing a QOE? Like, should you ask for a completely seller finance deal? Like, how do you deal with those types of situations, or do you just pass?
So talk to Alan or another SBA banker, like wait before ordering a QE, just to see what the bank will support. I'd also say like use common sense, sort of financial literacy to understand, hey, like the revenue is 7 million and the revenue is 3 million and they're claiming they make 1.2 million, SDE. That's a little aggressive, right? To have like, a 35% net margin. So that'd be like step one, is make sure like the financial metrics make sense. If what they're saying aligns with, a 10 to 20% EBITDA margin, it's probably solid. Step two, which you still want to do, even if step one looked good, is bring it to your banker. Say, what do you actually support based on this?
Alan rejected it. The top line revenue is like, they're claiming 2 million, and then the EBITDA is 1 million. So
Well, there you go. So yeah, I'd say that doesn't, what kind of business is it?
It's a service only plumbing business.
Yeah, but how many plumbers?
5 techs, 2 admin.
Okay, I mean, so that basically means they're charging like 65% gross margins probably.
hmm
What are their,
I don't know the gross margin yet. I'm talking to the seller on Monday.
so I mean, just take 2 admin and seller, right? Just assume the admins make like 40K each and the seller's pulling in, you'd at least want to add back like 100K, right?
hmm
So there's 180K, or let's say 200K out of your 2 million already, right?
hmm
So you're looking at like 1.8 million in gross, or you're looking at very large gross profit margins to hit the 1 million.
hmm
Yeah, I mean, you could push for massive, like an all seller financing deal.
hmm
At that, it's not unreasonable.
Okay.
On market or off market?
It's on market.
Okay.
hmm Yeah, I'm pretty skeptical, but just seeing where it takes me.
Yeah. But just keep in mind, like that's a great example of like an owner operated business where if you want to grow it at all, your EBITDA margin's going to have to follow something, realistic. The first business that we bought with Snowball it was actually a 3 million EBITDA business off of 9 million of revenue. And basically the 2 owners probably worked like 5 jobs. And that business in the first year, like just to replace those 2, they stayed on for a full year, but just to replace those 2, we needed like 5 people. And so we did a great job in sort of growing the business and gross profit, but it took us 2 years to hit the same overall EBITDA, even though we grew the gross profit by like 40%.
Mhm.
So now the business looks like normal. And it's got maybe like a 15% EBITDA margin or closer to 20% EBITDA margin. But that's a standard scenario, right? It's also way more valuable if you were to resell it, but
Mhm. And they're also saying like the owner doesn't do that much, and he's like a business guy, not really a plumber, but he's the founder of it and it's like a 20, 30-year-old business. And they don't have any management. It's like 5 techs, like a few senior ones, a few junior ones. Like, does that also sound like BS to you? Or
well, so a service business, it's his revenue per tech aligns, right? 400K, which is relatively high in plumbing.
Mhm.
And so that's reasonable. 2 people in the admin side. So one person's probably a dispatcher / CSR / office person. And the other person might be like bookkeeper / office person / backup CSR. That aligns. It's possible. Plumbing businesses are pretty simple. That would be impossible if they did any type of construction
Mhm.
in addition.
Right. Yeah, it's 100% service.
Yeah. So it's not impossible.
Okay.
But I just
Thank
want
you.
you to keep in mind, for you to grow it, you're going to need service managers. You're going to need warehouse people. You're going to need, probably just those 2 things.
Mhm. Okay, good to know.
Do you know actually if he has a service manager as one of those?
I don't know who the admins are. I'll find out on Monday. Why?
Yeah. Well, just because if he's the service manager, you definitely have to replace him in addition to taking, you replacing him as GM. So
Mhm.
that's an added cost.
Mhm. Okay, good to know.
Mhm.
Okay, thank you.
Yeah, no problem. Hey, Mark, you there?
I am. I'm in a coffee shop. Can you hear me?
Yeah. Just wondering if how your deal's going, the manufacturer.
Yeah, I was late because I was on a phone with her. So it's chugging along, knee deep into the business plan. I will say that um, using the live plan format, which is going great, it actually helps you kind of frame up your approach to the business. Love like the sections on what are you trying to solve and um, the go-to-market sections. Really helpful for doing the deeper research on the business I'm getting into. It's interesting. One of the things that just happened is, and you've said this before, right as we're getting close to it, we lost a major contract. The foot came off the gas, trying to see if we need to retrade or restructure the deal. But one thing I will say, the deal fatigue, I thought it was just a term of art. It is real on both ends. So definitely helpful to know that that's something to, to take in mind that you're going to deal with on this. It is a slog. I'm an intermediary between the seller and the bank, and no one wants to play fair. Feet are dragging, all that good stuff. But I will say this: it's an amazing process. I still think it's a solid business. Hopefully, we can expedite things here and have some good stories to tell soon.
Your LOI signed already? Your post LOI?
Yeah, post LOI. Yep. Yeah, I've done 2 site visits. It's a solid machine. I think it's going to be right for investment in talent and technology to get things up to snuff. But what you're just talking about is something that's piqued my interest. I have a owner who is a jack of all trades. She's purchasing. She's dealing with customers as business development. Those are roles I'll need to be able to replace and delegate. And so I am concerned about margin erosion for investments in the business, like you just dealt with there. So keep an eye on that.
Yeah, it's super common that as part of the diligence phase, like I said, that the business declines for one reason or not another because the seller takes a foot off the gas, or sometimes because the seller is focusing on answering your diligence requests and not growing the business actively. But it's also super common that AEs let it go and let it slide. And I would say this is an example where you definitely want to retrade, or at least have a forgivable note. If the business has like some really strong growth levers, at least have a forgivable note come in to make up the difference.
Yeah, absolutely agree. I think there's pipeline business that could mitigate the loss by about 50%, which is great, but it's still a loss. It is a material impact to the financials. And this is where I'm asking my broker to step in, a little good cop, bad cop, deliver the tough news and get prepared for, I think it's going to be more of a restructure than a retrade, but the forgivable note portion of it. But I think that keeps her in the game to help business be successful on the back end of the transaction. So it's just going.
Great. Good luck.
Thank you.
Any other questions?
Hey, Hayden, this is Hector.
Hi, Hector.
Hey, you're a little bit off topic, but what are your thoughts at a high level about the impact of SBA in general in the U.S., considering the output of the election? I know it's probably a loaded question, but will be interesting to get your insights. Do you feel good, bad, concerned, excited, or you feel it doesn't matter?
For the SBA, and so specifically for like the 7A program, I would say fairly neutral. I think for general business ownership and corporate taxation, quite positive.
Awesome. Good to hear.
Well, we'll reclaim these 10 minutes. Thanks, everyone.
Thank you. Have a great weekend.
Thank you. Hayden.
Have a